Hi, good day. My name is Elfreda, Jonker. I'm the Client Portfolio Manager at Alphinity Investment Management. Today I have Andrey Mironenko with me. He's one of our analysts in the domestic team and he covers a variety of sectors, including the technology sector that we will be discussing today. So Andrey, welcome.
Thanks for having me, Elfreda.
So as a starting point, tech has been in the news for so long. Everyone talks about generative AI and the Max 7 and everything happening abroad, but let's bring it back to Australia. What is your current outlook on the Australian technology sector, and particularly a bit about that AI theme that we haven't heard so much here in Australia?
Yeah, so in Australia, as you mentioned, the generative AI thematic is not as direct as it is in the US.
Yes.
However, there are definitely companies with generative AI exposure, names like Goodman Group, which obviously provide the data center training for training and inference, but then also under my coverage, Xero is building Just As Xero, which is a generative AI product. Data3 is a company that is the largest reseller of Microsoft in Australia, so they provide generative AI readiness audits and then consulting and implementation services around that. So there is some exposure. Ultimately for us, as you know, our process is all about earnings leadership from both quant and fundamental perspective, and picking individual stocks which we see as those earnings leaders rather than kind of a broader sector focus. And we definitely do find opportunities in Australian technology sector in line with our process.
So let's talk about some of those opportunities. I know you've mentioned Xero. Can we maybe start there? Why do you like Xero? What are some of the key drivers for that sort of underlying earnings growth that we're looking for?
Yeah, absolutely. So Xero, as you know, is an accounting software provider,
Yes.
And they have been getting earnings upgrades through a combination of ARPU, so average revenue per user, which was driven largely by pricing, and also changes in packaging, and also through operating leverage. So they have set a soft rule of 40 goal and have outperformed it in the most recent half. So that has driven earnings upgrades as well. And then in terms of why we think this will continue, so we see primarily on the ARPU side, we see further benefits from pricing. They have changed packaging to bundle more functionality like payroll and payments into more of their plans. And over time, they're also seeking to convert more of the lower value partner edition subscriptions into higher value business edition subscriptions, which come at a higher price as well. And as they have made a lot of product improvements around payroll and payments, this should improve the attach rate over time as well, which is also incremental revenue opportunity. And then we see the potential on the subscription side. They're doing a lot of marketing experiments across the funnel. They've done early experiments with promos, so this can help them grow the subscribers numbers as well. And all of that combined with operating leverage gives us our view that they can continue to outperform on earnings.
Exciting, a number of different levers to pull there. So let's pivot to another exciting name that we have in the portfolio, Technology One. Tell us, why do you like that company specifically?
Yeah, sure. So Technology One, as you know, is an ERP software provider, primarily to local governments and educational institutions, but also to a number of private sector verticals as well. It's primarily in Australia and New Zealand, but also has a growing franchise in the UK. And what we like about it from our process standpoint is they have recently upgraded their guidance, so they have pulled forward that 500 million ARR target to FY25, and they've given earnings or profit before tax growth guidance of 12 to 16%, which historically has been 10 to 15%. And this management team generally only increases that guidance if they think they can hit it on an ongoing basis in future years as well. So that has driven earnings upgrades in FY26, FY25 to some degree. So you have to look a little bit further out, but you see earnings upgrades from that. And we see a lot of further levers for them to continue that strong growth on top line. So we initially went into the stock on the thesis that as they finish their conversions to SaaS from on-prem, which helped them grow top line because of higher pricing for SaaS, we saw that the other sources of growth has been accelerating, and therefore we believe that they can sustain that growth even after the migrations finish, and that's what the most recent results have demonstrated. And we see a number of further levers for them to continue driving that top line growth, such as SaaS Plus, which is their implementation, a new implementation model, or DXP, which is their new front office product for councils and education institutions, as well as the opportunity in the UK. So they have a much more fit for purpose products there for financials, for HR and payroll, for student management, had some early wins there, and also through increased cross-sell. As more customers are on SaaS, it's easier to cross-sell more modules and products to every customer. Given that it's a high quality business with a history of operating leverage as well, we see that as potential to drive earnings upside over time as well.
Great. Well, thank you, Andrey. And thanks for listening. For more information from Andrey and the team, please visit alphinity.com.au. Thank you.